Ladies and gentlemen, it's a great pleasure being here with Jim Rickards, the author of so many best-selling books. He's also a member of our advisory board and a dear friend. He's also a keen reader of our annual In Gold We Trust report. We just published the 11th version of our report a couple of days ago, and in the following minutes we will discuss from our point of view that the most important topics of the report with Jim Rickards. It's a great pleasure having you, Jim, and yeah, let's get started.
Ronnie, it's great to be with you. Thanks for inviting me. And by the way, before we jump into the discussion, I just want to compliment you and Mark on this extraordinary job. I know this has been coming out for some years, and I've been a reader of it all the way back to before your fund started back in the Erstbank days. I read it very closely, very carefully, and I know hundreds of thousands and now millions of people around the world are doing the same thing. But it's a landmark, it's a classic, but every year it keeps getting better. So congratulations.
Thanks so much. It's so kind, Jim.
First of all, thanks a lot, Jim. I remember when we were walking Vienna, you told me, do you know this guy working for Erste Group? He's writing a big report on gold, and he said, and I said, yeah, I'm standing next to you, Jim. So
Right.
there are not too many gold bugs in Vienna, unfortunately, but we're working on it.
Right.
Well, some facts about the report for those of you who don't know the report. It's quite a brick. This year again we wrote roughly 170 pages. It is published for the 11th time in 2017. It's, as I've said, it's quite a long read. So we also made a compact version with only 30 pages, and we've got the report in a German and in the English version, and it can be downloaded for free on our new webpage ingoldwetrust.report. What is the executive summary of our new edition of the report? First of all, last year we said that gold is in the beginning of a new bull market, and Donald Trump's election, of course, kind of dampened the gold price increase, but still gold was up 8.5% in 2016, and it's up 8.2% since January 2017. I don't think that's a bad performance. From our point of view, the further development of the normalization of monetary policy is the litmus test. Everybody's talking about quantitative tightening these days. From our point of view, and this is exactly what you're saying as well, the Fed is tightening into weakness, and there will be a U-turn sooner or later, and this will probably be the point when gold will really pick up momentum. Also in the report, and we'll discuss that, we've got a very interesting interview with Dr. Judy Shelton. She's an economic advisor to Donald Trump, and she's got very interesting thoughts about a possible remonetization of gold. We are writing about mining stocks. We are writing about many different other topics, as you can see on this slide: technical analysis, portfolio characteristics of gold. We're writing about our monetary system, of course, about cash bands, about populism and its true cause, which is the economic misery that we're in. But in the following minutes we will mainly discuss those green highlighted topics with you, Jim. So where things stand: white, gray and black swans, the de-dollarization, the interview with Dr. Judy Shelton, and a bit, of course, as everybody is really interested in that, Bitcoin. So Mark, do you want to get started?
Sure. So first slide we just uploaded here is one of the first slides of the report also, and basically we already mentioned everybody's talking about monetary tightening or normalization of monetary policy in the US. But looking at the bigger picture, I think it's quite important to note that combined balance sheets of the major central banks are still expanding somewhat, or quite extensively, one should say. Gold price has decoupled of this development for quite a few years now. So Jim, what are your thoughts on this first slide?
It's pretty scary. It's funny. You guys have presented this in a very helpful way in two respects. Number one, you're showing the growth of the money supply of the individual central banks, the major ones, China, Japan, European Central Bank, the Fed, and the Swiss National Bank. So that's a good mix. But then you show the total where you kind of have each thing piled on top of the other and then put gold on top of that. So it's a very information-rich chart. You know, my first book, Currency Wars, came out in 2011, and I'm working with my publisher on a revised second edition. It's going to come out later this year. It'll still be called Currency Wars, just second edition. I'm thinking of it as Currency Wars for the Age of Trump, basically updating it. You know, when I reread it, it had a hard stop in 2011, of course. That's when the book came out. But at that time, as you well know, gold was at an all-time high. Dollar was at an all-time low. And a lot has happened since then, so I'm updating it. But one of the charts I had in the book toward the end, I think it was in chapter 11, was if you had to go back to a gold standard today, if any of these central banks or all of the major central banks on a global basis had to go back to a gold standard today, what would the implied non-deflationary price of gold be? In other words, if you had a new monetary conference, and it's funny, I see, I jump ahead a little bit, I see Dr. Shelton is talking about the Mar-a-Lago conference, and I've been writing some pieces on that as well. I think it would be a great place to have the new Bretton Woods, you know, rather than Washington or someplace boring. We could have this at Mar-a-Lago, and you know, it's a little bit of a joke, but it may not be a joke. That may actually end up happening sometime during Trump's first term, so let's keep an eye on that. But one of the things you have to do if you have a strict gold standard of the classic gold standard period time, 1870 to 1914, or even a modified gold standard, or, you know, as you know, there are many different kinds of gold standards, but no matter what you do, you've got, every gold standard involves some relationship between physical gold and paper money, some ratio, and it can be you know, 1-to-1 or 2.5-to-1, or you can pick M0 or M1. There are different definitions of money, unfortunately, and there are different ratios that one can choose. But no matter what you do, you have to get a non-deflationary price, because this was the great blunder, the great mistake of the gold exchange standard of the 1920s. To this day, you get into a conversation about gold with a mainstream economist, and the first thing they'll tell you is that, you know, gold caused the Great Depression, or gold was responsible for the duration of the Great Depression, which is absolutely not true. I mean, I've actually looked at that period, read the sources. There was never a time, I'll just speak about the Federal Reserve, there was never a time during the Great Depression when the Fed could not have expanded its balance sheet under the gold standard. The gold standard at the time required a 40% gold ratio. In other words, the money supply could be 2.5 times the amount of gold at the market. So you take the gold, at the time it was $20.67 an ounce, multiply it, that gives you a dollar figure, multiply that by 2.5, and that was the money supply. Well, the actual money supply never exceeded 100% of the gold. In other words, the Fed in the early 1930s could have doubled its balance sheet without breaking the gold standard at the time and without you know, violating the law. They didn't do it. So whose failure was that? Was that a failure of gold, or was that a failure of monetary policy? Of course, it was a failure of monetary policy. Gold was never a constraint on money supply during the Great Depression, ever. The problem was banks didn't want to lend. People didn't want to borrow. There was regime uncertainty. There are many, many ways of explaining both the onset of the Great Depression and the duration of it, but gold is not one of them. It's one of those myths that, you know, just has to be demolished. You can't demolish it too many times because it persists. But when they did set up that gold standard, they got the price wrong. In other words, the UK went back at the equivalent of about, as I mentioned, $20 an ounce. They should have had a much higher price for gold based on the expansion of the money supply in the UK during World War I. They doubled the money supply to fight World War I. That's completely to be expected. Wars are existential, and you have to do whatever it takes to win the war. But when the war is over and you've won, and you look at your money supply and you look at the gold, And you say, well, now what do we do if we want to go back to the gold standard? Well, if you've doubled the money supply, you pretty much have to double the price of gold. Or if you want to go back to the old standard, you have to cut the money supply in half.
Yep.
Well, that's what the UK did. They cut the money supply in half, started the depression in the UK years before it started in the United States, and then spread around the rest of the world. So the great blunder of 1925 when they did this was they got the price wrong. They went back to the old price instead of kind of being honest and recognizing the fact that you needed a higher price because of the money printing. Well, flash forward to 2017 or 2018, if there's a new monetary conference at Mar-a-Lago, as Dr. Shelton suggests, the single most important question in the design of a new gold standard is going to be, what's the price? And it's not going to be $1,245 an ounce, which is the current price. I have a screen open. I'm just looking at that. So what's the implied price? So basically, I took the old math. I took M0, I took M1. You can debate that. You can M2. You can debate the money supply. I did it U.S. alone. I did it with all the major central banks. And I did some at 40% and some at 100%. So it's like a menu, pick your money supply, pick your ratio, pick who's in it, and then just do the math. And the math is easy. I mean, it's 8th grade math. There's no calculus involved. You just do a little division. Well, I had to update that chart from the 2011 book. And when I did it, I was shocked. I mean, I was literally shocked at the new prices. Something that was $5,000 an ounce, that would be 40%. Using M0 is now $10,000 an ounce, or something that was $40,000 an ounce if you want to use broad M2 with 100% backing is now $60,000 an ounce. In other words, nothing happened to gold. An ounce of gold is still an ounce of gold. What happened was that as much as the balance sheet, the central bank balance sheets had expanded between 2008 and 2011 when I wrote the book, if you look at what happened between 2011 and 2017, it's absolutely shocking. You guys have captured in this chart, either money doesn't mean anything or it does. Take your pick. If you think it's just a lottery ticket, then good luck with that. But if you think it's meaningful, then you can't expand the money supply and not expect very, very dire consequences. And again, I think you make that point very emphatically. The consequences could come up in a lot of different ways. We could have, because one of the criticisms I think of Paul Krugman, we're on this call, maybe a good thing that he's not, I'm not quite awake yet, but if he were, his criticism would be, look, in 2008, 2009, 2010, when this QE1 started, and even the early days of QE2, a lot of people, and I'm going to include myself, were saying, this is going to be inflationary. You can't print this much money without having inflation. And the inflation never showed up in the conventional indices. So whether we take CPI, PPI, PC, price deflator, they're all different measures of inflation. It has not shown up. In fact, lately we've had disinflation. So a critic like Krugman would say, see, I told you so. You can print all the money you want and not have inflation. But of course, an Austrian economist such as yourselves, and I don't, I like Austrian economics. I don't rank myself as an Austrian. I use complex dynamic systems analysis. But even so, I mean, if we're all sort of getting at the same thing, would say, well, sure, but there are different kinds of inflation. There's price inflation in consumer prices, but you can also have asset inflation or asset bubbles. And that is what we've seen in stocks, in real estate, in emerging markets, et cetera. So the inflation's there. It just showed up in asset bubbles rather than consumer prices. And they're non-sustainable and they will correct. And so, pardon me, we're going to have horrendous meltdowns in a lot of these markets. You can see that coming, and I think that idea is becoming a little more widespread right now. So, yeah, I think your chart captures in one place the unbelievable, really shocking amount of money printing, and also points to a very catastrophic outcome.
Great. It wouldn't be Jim Rickards if he could already talk about the half of the gold report in 2 minutes. Love that opening statement. In the meantime, we've been flipping around a little bit and trying to help your arguments with some other charts also from the gold report. So now we're back to page 6. What you just said last. Welcome to the everything bubble. So we had inflation, we had the asset price inflation, obviously. I think this chart is quite scary. You see the last 3 cycles of asset price inflation dot-com bubble, housing bubble, and now some are referring to the everything bubble. I think you already mentioned it, but any special thoughts still on this chart?
No, I think you've captured it very well. The only thing I would add, since we already talked about this, is that, and this is actually not surprising, each bubble gets bigger than the one before. And of course more dangerous, and the consequences of the bubble bursting are more catastrophic. But that's actually not surprising, because the debt expansion, independent of the particular assets you've highlighted, .com, housing, and now the everything bubble, and I think that's a pretty good way of thinking about it. But if you go all the way back to the really, I could say the 1980s, but very prominently beginning in the 1990s, we've been running our economy on debt. We don't, to the extent we've had any real growth. If you correlate real growth and debt, you can see very clearly. I mean, there are a couple of drivers of growth, a number of them, and some of them are headwinds right now, and some of them are tailwinds. Demographics, technology, education, just simple hard work, innovation, entrepreneurship, natural resources. These are all classic drivers of growth. Some countries have all of them. Some countries have none of them, but still will do well. Of course, Singapore is a great example of a country that has almost no natural resources, but a very talented workforce and a lot of innovation, and their economy over a long period of time has done fairly well. So you have all these factors, but what's been happening is that we keep handicapping, or actually I meant to say kneecapping, or damaging or hurting the classic inputs. Our education system, at least in the United States, is deteriorating. We have demographic headwinds, that's very well known. Too much regulation, too much regime uncertainty. Imagine today you're the chief financial officer of a Fortune 10 company. So, take your pick, Exxon, IBM, General Electric, the Volkswagen, any of these major companies, and you're being asked to go to your board and sign off on a $5 billion 10-year capital investment. We're going to spend $5 billion on something, a new plan or expansion, and you have to go to your board and look them in the eye and tell them how this is going to play out. Well, do you know what your health care costs are going to be? Do you know what your taxes are going to be? Do you know what the regulatory regime is going to be? Do you know what the litigation landscape is going to look like, et cetera? In other words, there's so much uncertainty that you actually can't make those projections, not with any degree of rigor. And so what capital tends to do, capital goes on strike. Capital will say, well, okay, we don't have to make this investment right now. There's a lot of uncertainty around it. We don't want to bet the company, so we'll wait. We'll wait until, they pass a health care bill. We'll wait until they pass a tax bill, et cetera. And all these things are on the table right now because of Trump, because with Trump, it's not more of the same. Going back to the Obama administration, he has a lot of very different policy proposals. But we don't know how those proposals are going to play out. Right now, it looks like none of them are happening, but some of them could, and how they play out, if they even do, there's a lot of uncertainty around that. And so we're not getting investment as a driver of the economy. We've done a lot of damage to all the classic drivers. So how do we drive the economy forward? The answer is debt. But the problem is, every physicist knows this, and every economist is supposed to know it, although I think a lot of them might have skipped this class, is if you look at any return curve, you have this phenomena of diminishing marginal returns and ultimately negative marginal returns. And so what happens is when you start out down the road, you get actually very good payoffs. And they go up and up, and then they level off, but you're still getting a payoff. Then they start to go down, and then they actually go negative. But we're certainly on the downslope, and in some, I think we may be across that boundary into the negative, where we add $1 of debt. Not only do we not get $1 of growth, we get 98 cents or maybe 70 cents, and we're just piling more and more debt on. So the debt machine, we've handicapped, again, I misspoke, we've damaged all the other drivers of growth. We over-relied on debt, and now debt is not working the way it is, and so growth is hitting the wall. So it's a very, I think it's scary picture is a good way to describe it.
Absolutely, Jim. We've been writing about this diminishing marginal utility quite often. We also made the comparison with bio, where the first sip of beer tastes best and then it gets worse and worse. After the 10th beer, it doesn't taste so well anymore.
Right.
But here's another chart showing commodities versus stocks. We called it the everything bubble before, and we said real estate is at or close to its all-time highs. Stocks are at their all-time highs, and bonds are as well, especially in the Eurozone. So what is really cheap, not only on an absolute but also on a relative basis, it's commodities. And you can see on this chart here that against commodities versus stocks are at an extreme low, and we just believe in mean reversion in markets. And we think that last year commodities made their lows and they started a new bull market despite the fact that the dollar was extremely strong. I think the dollar index made a 14-year high, and commodities were still up. So that's a pretty good sign. But let's jump in the presentation a bit forward. The next chart shows the bull markets in comparison. We often say that this correction that we're seeing since 2011 reminds us a bit of the mid-cycle correction in the 70s, when there was massive disinflation from 1974 till 76, when economic confidence came back and when there was a sell-off in gold from $200 down to $100. And then we all know within 4 years gold went up 8 times basically. So I think there's a lot of similarities, although the current cycle, of course, is longer than the cycle in the 70s. But what's probably one of the most fascinating chapters in the report is the one about gray, black, and white swans. And I'm sure that you've got very interesting thoughts on that. And actually this chart is very scary from our point of view, because we didn't expect that there's such a strong consensus. This shows the 89 analysts, economists that are questioned by Bloomberg on a regular basis. So those are the most important economists making economic forecasts. And out of those 89 economists, none, zero, is expecting a US recession within 2017, 2018, and 2019. So everybody is basically seeing growth between 2 and 3%. Nobody is seeing a recession, although from our point of view, there are massive recession fears. And we can see that from the flattening of the yield curve, although the last few days changed the picture a bit, but we're seeing a flattening. We're seeing so many economic numbers coming in really weak. There's a huge divergence between the soft data and the hard data. Tax receipts are very low. From an Austrian point of view, very important. We're seeing that credit growth is sluggish, not only for commercial credit, but also for retail and real estate. So from our point of view, there's quite a lot of signs that a recession is in the cards, 2017, 2018. And actually, I think this is also one of our finest charts in the report on page 11. This shows that since 1914 we had, I think, 19 tightening cycles, and out of those 19 tightening cycles, in 16 of them, we have seen, after the tightening, we have seen a recession. So from our point of view, the tightening probably already started with the tapering by Bernanke. So it's already going on for a while. So it's quite fascinating that nobody is actually seeing any recession fears. And what we always suggest is as soon as the market realizes that recession fears are bigger than anticipated by this very strong consensus, then of course we all know the Fed will make a U-turn. They will talk about lowering rates again. There will be talks about another round of QE, and of course there will be fiscal stimulus and so on. And this will probably be the point when gold really picks up momentum, and perhaps when stocks take a hit. So Jim, the floor is yours.
Well, thank you. There's sort of a short answer and a long answer. Of course, I'll give you the long answer, but the short answer is I agree with everything you just said. But let me put a finer point on that. First of all, when you say 89 out of 89 economists don't see a recession, to me that's a very good leading indicator of a recession. The fact is there's good social science research that says that economists do worse than, let's just say, a monkey at forecasting binary outcomes. And I don't say that in a disparaging way. It's just good science. In other words, a monkey knows nothing. And if you give them a binary outcome, up, down, high, low, recession, no recession, they will be right exactly half the time, and they will be wrong exactly half the time because they don't know what they're doing. And so you get a random outcome. Economists are actually wrong more than half the time. In other words, it's non-random. You need a factor analysis to explain why they're wrong more than they're right. And the answer is, you find it in behavioral psychology, which first of all, their models are flawed. They're using dynamic general stochastic equilibrium models, so those are not a good reflection of reality. So they've got the models wrong. They're using a lot of correlations and regressions in a world where things are different. I know that's considered a very dangerous statement. It's different this time. Well, sometimes it is different. I guess I would put it differently. When you say it's different, it might be different in a post-World War II business cycle regression context, but not so different if you look back over 200, 300, 400, 500 years, or in my case, 3,000 years, going back to the collapse of Bronze Age civilization, followed by the collapse of the Roman Empire. That's sort of a 1,500-year tempo that brings us to today. So the first problem is they're using, even when you try to use correlations, the data set is too short. But beyond that, economists would rather be wrong together than go out on a limb to be right. In other words, if they all say the same thing, and that's exactly what we're seeing in your data, if they all say the same thing and they're wrong, nobody loses their job because they just say, well, all these other guys were wrong too. I mean, nobody saw this coming. It was a black swan. By the way, I like the black swan is a great great catchphrase, and it does, Nassim Taleb gave it a lot of content. It's not a bad way to put it. I actually don't like the phrase myself because it's kind of like throwing up your hands and saying stuff happens. I'd rather use science, just different science, meaning science that reflects the reality, such as complexity theory. But so, as I say, 89 economists say no recession. Then the recession happens, and they all say, well, nobody saw this coming. Just look around. All these other 88 guys, didn't see it. Women didn't see it coming either. So they'd actually rather be in a pack for job security reasons and be wrong than to go out on a limb and say there's going to be a recession. I think there could very well be a recession this year for the reason you mentioned, which is the Fed is tightening into weakness. To me, I mean, that's pretty obvious. The data is weak. I mean, you recite some of it, but at least in the U.S., auto sales, retail sales, labor force participation, commercial loan origination, disinflation, many others, all these indicators are pointing to weakness at best. It might be a recession, but even if it's not a recession, the best you can say about it, it's an extremely weak economy. Why on earth is the Fed tightening into weakness? That's the real mystery. Are they stupid? Well, no, they're not stupid. I mean, I know a lot of them, a lot of the governors and regional reserve bank presidents and staff of monetary research department in Washington and the New York Fed. They're not stupid, but they absolutely have the wrong models. But they're doing it for a different reason. This is really important to understand. I think this is what the markets have wrong. When does the Fed tighten and when does the Fed ease? Going back through dozens of business cycles since the end of World War II. Well, the way it works is this. The Fed sits and watches. They watch. The economy gets stronger, unemployment goes down, capacity gets tight, prices start to go up, inflation starts to take off, and then they say, oh, gee, we better raise rates, and they do. But then inflation gets hotter, unemployment gets slower. They go, oh, we got to raise them again. Boom, boom, boom. In other words, they keep the Fed follows the market. The Fed never leads the market. Then eventually, the Fed tightens one time too many. The economy cools down. Unemployment goes up. Prices start to go down. there's more, capacity utilization goes down, et cetera. And then they go, oh, gee, we better cut rates. So again, the Fed, it's just a sine curve, it's just a wave. They tighten into strength and they cut into weakness, and they always follow the market. They never lead the market, and that's what the Fed does. So why are they tightening into weakness? The answer is that they did not tighten when they should have. They should have tightened a little bit. I'm not saying, 6% interest rates, but 25 basis point rate hikes in late 2009, when I first called for them, 2010, 2011. I mean, I was on CNBC in August 2009 with our friend Joe Kernan, and there was a Fed meeting coming up, and he said, Jim, what do you think the Fed should do? I said, I think they should raise rates 25 basis points. Just a little bit, because there was no liquidity crisis in August 2009. Yeah, I mean, unemployment was high, stock market was low. We were in the aftermath of the crisis, but there was no shortage of liquidity in August 2009, plenty of money sloshing around. So I said, just raise them 25 basis points, just as a way to tell the market that you're trying to get back to normal. Well, of course they didn't do that. They didn't raise rates until December 2015, more than 6 years later. So the point is they skipped a whole cycle in 10, 11, and 12. So now the problem is they're looking at a recession. They know the recession is coming. They don't put it in their forecast. They don't say it publicly, and they never have. But they know it's coming sooner than later. They're saying, well, gee, what are we going to do? If rates are zero and the balance sheet's at $4 trillion and we have a recession, we can't cut rates because we're already at zero. By the way, the evidence on negative interest rates is that they don't work. Those have been tried in Europe, Switzerland, and Japan. And again, pretty good evidence. We don't have time to talk about why they don't work, but it seems that people actually save more rather than less because you're taking their money away, and they have lifetime goals, and they say, well, I better save more because you're taking my money away. So they don't stimulate anything. But so if you say, pardon me, if you say negative rates don't work and you're at zero, and you say, well, what about quantitative easing? Well, if you're at 4 trillion, what are you going to do? Go to 6 trillion, 7 trillion? I mean, the modern monetary theorists, my friend, Professor Stephanie Kelton, Paul McCulley, Richard Duncan, Warren Mosler, there's a whole group who think the answer is yes. Just, there's no limit on the amount of money you can print, and why not go to 8 trillion or 12 trillion? I don't agree with that. I think there's an invisible confidence boundary. I think you will destroy confidence in the dollar at some point. I think the Fed agrees, by the way. That's why they're trying to normalize the balance sheet, even though they don't say so. So what's going on right now is they skipped a cycle. They're playing catch up. They're like, gee, we better raise rates before the next recession. We better normalize the balance sheet before the next recession. The problem is your timing is 5 years, 6 years too late. They may end up causing the recession that they're preparing to cure. And in fact, I think they will. And later this summer, when you see this weakness that we just talked about, the Fed will be the last to know, and the Wall Street economists will be the last to know. But when it does appear, they'll have to say, sorry, just kidding, we're not going to raise rates in September. We're going to go slower on the normalization of the balance sheet. This is so-called forward guidance. That's a form of ease, and then I think that's a huge catalyst for the price of gold, because the Fed will essentially be admitting that they can't complete this experiment. And it is an experiment. We're all just guinea pigs. I spoke to Bernanke. That was the word he used. He said, this is an experiment. We don't actually know if it works or not.
Jim, we could talk for many hours, but you're a very busy man, and there's some time constraints. So let's just jump over a couple of slides. We're talking about other gray swans, a credit crisis in China, for example, a political crisis in the US, some sort of impeachment, geopolitical escalation, an inflationary boom, and a reset, and their consequences on gold, of course. We also, and we touched that topic already, we've got a very interesting chapter about the de-dollarization and of course what countries like China and Russia are currently doing with the gold holdings. You once said in our advisory board discussions, if you want to play poker with the big guys, you have to bring a sufficient amount of chips to the table, and those chips are golden. So I think this is a very, very good analogy, and those guys, they all buying golden chips at the moment. We mentioned Judy Shelton. I think it's another very interesting chapter in the report. She has got very interesting thoughts on sound money. She knows our monetary system and its flaws and its consequences, and that makes me kind of confident that also the vice president in a fantastic speech in Detroit, I think he spoke about sound money and said that that's really crucial for our prosperity. But Bitcoin, I think this is a hot topic at the moment, and there's no time to talk about that. From our point of view, Bitcoin in comparison to gold, I mean, that's just from a market capitalization, that's a huge difference. Bitcoin has a market cap of roughly 60 billion at the moment, and gold has 7 trillion. So I think there's way to go. But from our point of view, the interesting thing regarding Bitcoin and cryptocurrencies is actually the fact that people start discussing again what is money, what are the criterias for good money, for sound money. We're seeing competing currencies, and that's from our point of view a very, very positive thing. And it seems that Bitcoin was kind of created with the role model of gold, because the white paper of Satoshi Nakamoto very often refers to ideas that sound very similar to gold. And from our point of view, the stock to flow ratio of gold and of Bitcoin are crucial for understanding the monetary role. But just for a second, if you've got 2 minutes left for us, some scenarios for the gold price. From our point of view, scenario C and scenario D are probably the ones with the highest chances, and those terms are characterized by inflationary boom, that would be scenario C, or an adverse scenario with some sort of renewed easing where gold could hit up to 5,000. I think that's not the remonetization scenario where we also could hit price targets of $10,000 and so on. But I think from our point of view, those scenarios that are for this presidential term, so until 2021, so that's the time frame of those scenarios. Those are pretty interesting. And as you've said before, due to all this monetary inflation that is happening at the moment, in the last couple of years, gold actually got significantly cheaper in monetary terms. So if you still got a second, it would be interesting what you think about our scenarios.
Yeah, thank you, Ronnie. I've got a few minutes, and that's a lot of material. Let me just, I'll just be brief on each one of those. Let's flip back to page 13, the gray swans. I think it's a very good list, by the way. You have one of your factors is geopolitical escalation. I would add, just to put a finer point on it, the United States is heading for war with North Korea. I give that a very high probability, unfortunately, because it's going to be a devastating war. Probably in 2018. If I'm wrong about that, it will be in 2017, but I would say most likely 2018. The thing about wars is that you don't just go into a major war overnight. You don't just wake up and say, oh, let's have the war. Look at the war in Iraq when the United States invaded Iraq. That war started in March 2003. But in early 2002, some of the commanders were given orders, particularly James Mattis, who's now our Secretary of Defense. But prior to that, he was a 4-star Marine general and commandant, or commander rather, of the 1st Marine Division. And he was told in 2002, he said, get ready, we're going in. In other words, the insiders in the military and the White House knew we were going to have a war. Now, it wasn't certain, but the probability was so high that you had to prepare for it. So if the president did decide to do it, you weren't doing it from a standing start. So I look at 2017 as exactly analogous to 2002, and that was the year before the war. The orders have already been given. Just listen to what General McMaster, the National Security Advisor, is saying. Listen to what General Mattis, Secretary of Defense, is saying. Listen to some of the things coming out of the White House. Look at how the U.S. is now putting sanctions on Chinese banks because of their support for North Korea. Not North Korean banks. They're already banned from the system. We're starting to ban Chinese banks. Secretary Mnuchin the other day was very emphatic about that. So we're preparing for war. I don't see anything that will deter Kim Jong-un from the path he's on. So that's not a gray swan. That's a whole flock of black swans that are definitely not priced in. De-dollarization, I think it's just a matter of time. Russian gold reserves, you could have a similar chart on Chinese gold reserves. Of course, we know that the Russians are a lot more transparent than the Chinese, but we have, fairly good information on Chinese. The Chinese chart would look very similar if you took it back to 2002, 2003. With the official numbers, with the unofficial numbers, it would be even steeper. I have a very simple way of thinking about this. Russia and China are accumulating as much gold as they can get without having too much market impact. Exports of gold from China are banned. I just got back from China recently. I was there. I met with two of the largest gold dealers in China, ICBC and UOB, two of the biggest banks in China. They told me demand is still through the roof. You can't export gold from China. All that mining output is essentially off the market. China's the largest single gold producer in the world, and their mining output is off the market because it cannot leave China. And Russia is buying more than, or acquiring more than their entire gold output. So two of the 5 largest producers are not letting their gold out of their sight, which I understand. But here's a simple question. Are the Russians and the Chinese stupid, or do they see something coming that most people don't? Well, I have news. I've been to Moscow, I've been to Beijing, Shanghai, I have friends in both places, I've been in both countries. They're not stupid. In other words, this is very clear evidence that they see a monetary reset coming. Why Americans don't get it, I have no idea. I think Americans have been pretty thoroughly programmed to disparage gold, but the Russians and the Chinese know better, so I think this is pretty good evidence of that. I am slide 16, I'm a huge fan of Dr. Shelton. I'd like to see her, chairwoman of the Federal Reserve Board when Janet Yellen's term is up. The thing I like about, a lot of things I like about Judy Shelton is that, yeah, she's an advocate for gold, and she wrote a very excellent book in the 1990s about gold, still in print, still sells well, very far ahead of the curve, regular contributor to the Wall Street Journal. But she's not an ideologue. She's not dogmatic. She says, yeah, a gold standard would be better, but there are different ways of referencing gold, different ways of blending gold into a gold system. You can have gold-backed bonds, etc. So I like her intellectual flexibility and her intellectual curiosity. So she's an advocate for gold, but she's not sort of a hard-shell gold person, and I think that's just the kind of person you need. Look, just putting Dr. Shelton on the Federal Reserve Board of Governors, if not chairman, and I hope she would be chairman, sends a very powerful signal. I think that U.S. growth would pick up, the minute that was announced, because people say, aha, okay, finally, one of the uncertainties has been removed. We're going to have sound money, so we feel more comfortable investing. Yeah, I'll just end briefly on Bitcoin. You're right. We don't have. We could talk a whole hour about that, but we don't necessarily have a lot of time on that. But I would make the point that first of all, Bitcoin and this other. I mean, there are 100 cryptocurrencies. They're out there now. We have, instead of IPOs, we have ICOs, initial coin offerings, where they'll in exchange for hard-earned cash, they'll sell you a digital token of who knows what value, but those people have been raising tens of millions of dollars selling digital tokens. I don't know whether they include a free T-shirt with that, but maybe. But here's the thing with Bitcoin: it has not been through a business cycle. And it was Bitcoin and the blockchain were invented in 2009. Economic conditions were pretty bad, but we were in an expansion, a weak expansion, but still an expansion. Every other asset class you can think of, currency, stocks, bonds, gold, commodities, etc., we've seen their behavior through multiple business cycles. With Bitcoin and the digital currencies, we haven't. We've only seen them, in other words, in a bull market and a growing economy. We don't know how they'll perform in a liquidity crisis. My estimate is that they won't perform very well at all. But that's one reason to be wary of them. But I have a lot of criticisms of Bitcoin, and then I get trolled on Twitter. People say, you're a Neanderthal, you're you're back in the Stone Age. You don't understand technology. I think I understand technology pretty well, and I've actually read the technical papers. I've worked with branches of the U.S. government in thinking about this and how terrorists use cryptocurrencies to finance their operations and how you can interdict that. And I can't really talk about how you do it, but I think the Bitcoin fans might be surprised at the ways you can do it. The other thing is this is basically, the Bitcoin advocates talk about how you're free from state power. We finally have a currency that's not produced by a state, not subject to government control. I have news for you. You're never free from state power. If you went to Mars, you would not be free from state power. It's just that the states haven't, governments haven't chosen to act yet. They're watching, but think of them as like a tiger or a snake in the grass. They'll pounce when they want to. Just a very simple example. If you bought a Bitcoin for $1,000 and you sell it or transact with it at $2,000, you have a $1,000 gain on your purchase and sale of Bitcoin, which you have to put on your tax return, at least for U.S. citizens, and pay tax on that gain. So how many Bitcoin transactors are actually doing that? I don't know the answer to that, but my estimate is that it's a fairly small percentage, which means all the people transacting in Bitcoin, at least the Americans, are tax evaders. Which is, you can go to jail for that. That's how they got Al Capone, famous gangster of the 1920s. They didn't get him on bootlegging and murder, being a gangster. They got him on tax evasion. So that's just food for thought. People say, well, the IRS will never find out. Well, that's what all the Americans with Swiss bank accounts used to say. The IRS will never find out. Well, guess what? They did find out. The Treasury said to the Swiss banks, you can't set foot in the United States unless you give us all that information. And the Swiss banks complied. They did give the U.S. Treasury all the information. So these Bitcoin exchanges are going to get their subpoenas, and then they're going to tell the government to jump off a bridge, and the government's going to say, we just shut you down. We have treaties. You may not have heard of treaties, but we have a lot of partners around the world. We have ways of extending our jurisdiction. The U.S. is very good at that. And at the end of the day, you have jails, weapons, and some countries, torture chambers. So when people say they'll never get me to give up my code, I would say talk to someone who's been waterboarded. Now, I realize that's an extreme statement, but I'm making a point. My point is that if you think you're independent of state power, guess again. So these are all reasons to be very wary of digital currencies.
Great, Jim. We covered a great lot of stuff, so I think we're almost through. Thanks so much for your time. Have a great summer. More information can be found on ingoldwetrust.report, and we also have a Twitter account since a few days. It's IGWT report. Thanks so much. Looking forward to our next advisory board.
Jim, thank you very, very much. It's been a great pleasure, and have a fantastic summer. Take care, my friend.
Great, thanks. You too. Bye-bye.
Thank you. Bye-bye.